Hello, my name is Gabby, and my group members include myself, Bobby, Lynette, Amber, and Danielle. Today in this presentation, our group will be discussing credit. To begin to investigate credit, I will begin by defining what is credit. Following this, Bobby will be discussing the importance and implications of credit scores. To further drive these facts, we will present a hypothetical scenario everyone is likely to experience in their life: purchasing a home. Bobby will then be outlining what you can find on your credit report. Next, Amber will be sharing how credit scores are calculated and what facts influence the values of these scores. She will also be highlighting who actually makes this calculation and keeps track of your credit score. Following this, our group will present on how to view your credit score. Danielle will be discussing the differences between soft and hard credit checks, different digital platforms you can utilize to view your credit score, and who can view it. Next, I will be sharing our findings of what happens if you cannot pay back your credit and corresponding solutions to help you solve your debt problems. To finish the presentation, Lynette will examine how to build and rebuild credit through different factors that affect your credit score. So, what is credit? Credit has a few different meanings in the financial world, but for the purpose of this presentation of today, we will define credit as being essentially the trustworthiness others, such as financial institutions, have in you and is reflective in the amount of money you are able to borrow. Having good credit allows you to borrow more money. Credit is assigned to individuals based on previous credit history. Credit history is built by consumers making different financial decisions, such as outstanding credit card balances or making regular payments. Each person's credit has an associated credit score that will next be discussed by Bobby.
Hello, my name is Bobby Laguerre, and I will be discussing why your credit score matters. So lenders want to know how you have handled credit in the past to make a judgment on how you will handle credit in the future. Lenders will use your credit score and report to determine how reliable of a borrower you will be. It will help determine how much to lend you and at what rate. Auto dealerships, mortgage lenders, credit card issuers, and sometimes landlords require a credit check before they can approve you. A poor credit means a denial of the credit application or a higher interest rate. This can be applied to any kind of application. It may mean some credit cards are out of reach, or you will have to pay more in interest on a vehicle or home you want to finance. So in general, it will be hard to get improved by an insured mortgage lender with a credit score below 600. So these are the big institutions we all know, like RBC, TD, and CIBC, just to name a few. A score below 600 means you will have to apply to an uninsured or private mortgage lender, which will mean a higher interest rate. Once your credit score is above 700, you will generally have access to the best available rates. So here I will go over a few potential scenarios. So let's assume a credit score between 700 and 900. This means you would deal with major banks and prime lenders. We will assume the best case scenario is a 3.49% interest rate on a mortgage. Next, a 550 to 700 credit score. This means you will deal with trust companies and or bad credit institutional lenders. This has the potential to increase interest rates by 2% to 5.49%. Lastly, a credit score less than 600. Now, this may leave you to deal with private lenders who will charge much higher interest rates. In this scenario, 10 to 18%. To illustrate further, I have the two best scenarios from the last slide laid out. When agreeing to a mortgage, you generally lock in a certain interest rate for a specific term. So in both scenarios, we assume a $400,000 mortgage and a 5-year fixed term. In scenario one, we assume this person has a credit score of 700 or greater, and they could get approved for a 3.49% interest rate. This would mean they pay $64,755 in interest over the 5-year term. In scenario two, we assume this person has a credit score of 550 to 700. This means a 2% increase in interest rates. And that may not sound like a lot, but it means the borrower would have to pay $103,051 in interest over the 5-year term, which is about a $40,000 difference. So in essence, you want a good credit score because a bad one will cost you money. Whether applying for a line of credit, a mortgage, or a vehicle loan, it can make the difference between getting approved for that vehicle or home you really want or not getting approved. I will quickly go over the terms, credit score and credit report. So a credit score, as many of you know, is a 3-digit number based off of the info from your credit report. It tells the lenders how risky of a borrower you are. A credit report is a summary of your credit history. It is created once you borrow money for the first time or apply for credit. This information is used for your credit score. So when looking at your credit report, you will see a few things. First, your identifying information, so name, social insurance, address, date of birth. Next, your credit info. So these are accounts reported to the credit bureau from your lenders. So your credit cards, student loans, mortgage, and vehicle loans. Next, your inquiry information. This will be soft checks or hard checks done by the potential creditors or even yourself. Danielle will go over the differences between a soft and a hard check later in the presentation, but essentially anyone viewing your credit report will be able to see when creditors like auto dealers have made hard checks on your report. And this could potentially lower your credit score. The date and type or chapter of bankruptcies will also show up in your credit report. And lastly, your collection accounts. So these are past due accounts that have been turned over to collection agencies. They can be credit cards, hospital, retail, cable, or phone bill accounts, just to name a few.
Now we will move on and take a look at how credit score is calculated. A credit score can range from 300 to 900, 9 being the best you can have. A credit score is used to predict the likelihood that you will pay your bills. This shows lenders that you have a good history with credit and that you can be trusted in the process of borrowing. A credit score is only one of several things that lenders use to determine your credit worthiness. Throughout this section of the presentation, we will look at the factors that can affect your credit score, as well as the 2 companies in Canada that manage credit score. This image is most commonly seen when representing the credit score ranges. Now we will look at the factors that are considered when calculating credit scores. The first is payment history, and this accounts for 35% of your credit score. This shows that you have repaid your credit in the past, and things such as credit cards, line of credits, installment loans, auto loans, student loans, and mortgages can be included. Payment history also tracks late or missed payments, as well as how much you have had owing, how late your payments were, and how recently and how often you missed payments. The next factor is used versus your active credit. which attributes to 30% of your score. This means that the credit bureaus track how much credit you have available versus how much you are currently using. Revolving lines of credit, which you can borrow, pay, and reuse again, are also taken into account. For example, if you have a line of credit available that you have not used, the lenders will see that you have credit, but you are not using this. This doesn't tell them anything about how you are able to use your credit. The third factor that attributes to your credit score is the length of your credit history. This accounts for 15% of your credit score. The credit bureaus look at the longest, oldest, and most recent accounts that you have opened. Creditors want to see how you can properly manage your credit, and this is why it is important to start building your credit as soon as you're able to do so. Another factor when looking at credit scores is public records, which is 10% of your score. Creditors look at your history to see if you have claimed bankruptcy. They also look to see if you've had any past history with credit collection agencies, and they look to see if they can find anything risky that would warrant them giving you any credit. The last factor that is considered is the number of inquiries you or someone has made on your behalf. This process happens anytime your credit has been accessed. Inquiries require your consent, and some of them will affect your credit. Hard pulls or hard hits are inquiries that will affect your credit score. They are able to be seen a few times per year without any effect, but you should be sure that you are not having too many hard checks. Soft pulls or soft inquiries do not affect your credit score. These can include checking your credit score through your mobile banking app or a number of other credit score apps available to use. This slide represents the factors that affect your credit score as shown on a pie chart. Now we will move on to see who calculates and keeps track of your credit score. In Canada, there are two main companies that do so, Equifax and TransUnion. Both of these companies are publicly traded. Equifax is a global data, analytics, and technology company, and they play an essential role in the economy. They help companies in diverse industries such as automotive, communications, utilities, and healthcare. Equifax employs 13,000 employees across 25 countries for over 122 years. They are traded on the New York Stock Exchange, and their ticker symbol is EFX. Now we will look at the history of TransUnion. In 1968, Union Tank Car Company created TransUnion as a parent holding company. In 1969, they had the opportunity to grow a new business and acquire the Credit Bureau of Cook County. When they first acquired this company, they were manually maintaining 3.6 million card files, and they became the first company in the credit reporting industry. From the 1970s to the 1980s, they continued to expand through investments in technology, strategic growth, and acquisitions. In 1988, they had full coverage of the United States. In 1989, TransUnion Canada was formed, and in the 2000s, they entered the direct-to-customer market by acquiring TrueCredit.com in 2002. This was able to help millions of people protect and improve their credit through online services. In 2015, TransUnion refreshed their image, and they also opened on the New York Stock Exchange later that year as well. Their ticker symbol is TRU.
Hi, my name is Danielle, and I'm going to talk about who can view your credit score and credit records, and as well as who needs permission for viewing it. I'm also going to talk about the difference between hard and soft credit checks and how they affect your credit score. Afterward, I'm going to talk about some credit score apps. The following group of individuals require permission to view your credit score and credit record. Prospective creditors and lenders need to view your credit information to ensure that you are suitable for receiving borrowed money. Creditors need to check your history and be sure that you are capable of repaying the loan within a reasonable time frame without missing payments. In essence, they want to make sure you're not a risky person to lend money to. Landlords you may rent with need to check your consistency with making rent payments on time. Some red flags that would show up on your credit report would be things like evictions or always paying your rent late. These things will make you an unfavorable candidate. Insurance companies you may choose to receive services from will use your credit information to see which interest rate is best for you. Typically, individuals who have missed payments or collections are going to be subject to higher interest rates. It is important to note that insurance companies that you currently receive services from will check your credit from time to time to make sure you're on the right track. For this situation, they don't need to have your permission for viewing. Both potential and current employers will want to check only your credit report. The reason why potential employers will want to see this is to determine whether someone will be hired or not, whereas current employers use this to determine if an employee is eligible for raises or promotions. Utilities providers use this in order to make sure you're going to pay your bills on time and you're not going to miss payments. Now I will discuss the entities which do not require permission for viewing these records. Current creditors and lenders will check your credit records without your permission on a regular basis. The purpose of this is to ensure you're making payments towards your loans. In some situations, they may make adjustments to the lending terms. Debt collectors and agencies need this information so they can try to collect your debts from you and see if you're capable of paying the collections. Lastly, government agencies need access to credit information to check your eligibility for certain financial benefits and assistance granted by the government. Hard credit checks are used by financial institutions who are lending money to clients. The lending is typically for mortgages, applying for various loans, which include auto, personal, and student loans. Hard credit checks are also used for credit card and apartment rental applications. Permission needs to be given in order for a hard credit check to be completed. This inquiry can drop an individual's credit score by a few points. However, it is important not to apply for so many things at once which require a hard credit check. This is because a dramatic drop in credit score will be a result of this due to each inquiry dropping the score by a few points. So collectively, it will be a pretty big hit to your credit score. Soft credit checks are used for different purposes. First of all, background checks from employers, pre-qualified offers for insurance and credit cards, and also when you want to check your own score. Soft credit checks do not require permission to be viewed. In contrast to hard credit checks, soft credit checks do not affect your credit score and they can be done many times without consequences. Now I will discuss two popular free credit tracking apps. Although many online banks offer credit score and credit report services, these apps are always just another option to have. The first app is Borrowell, which uses data from Equifax to calculate your credit score. On this app, you can check your credit score and report, as well as receive helpful information to manage your credit and make improvements. Users can also use this app for keeping track of their bills, comparing credit cards, loans, mortgages, and insurance. Additionally, the app suggests banking options which users can implement in order to meet their financial goals. The other app is Credit Karma. The features of this app are, of course, checking and monitoring credit score and report, and with information that's relevant to helping you improve your credit. You can compare various credit cards. This app also has a section which allows you to sign up for loans and go through the different types and choose which one is best for you. They have some extensive mortgage services which aid users in the process of obtaining a mortgage, but they're also able to renew or refinance their mortgage. Most of the features of Credit Karma are very similar to Borrowell. However, one of the main differences is the data used for Credit Karma comes from TransUnion, which will make your score a little bit different. This is normal between the two apps. It won't be a big dramatic difference in score, but it's just important to note.
What happens if you can't pay back your debt? To be clear, being late on a few payments generally does not have a noticeable effect on your credit. You may notice it drop a few points, as long as you pay off your outstanding balances and do not make a habit out of this behavior. Although, if you find yourself frequently missing payments, this would be a trigger for your lenders to send your debt to collections. Lenders can use their own collections department. They may contract out to collection agencies who work on behalf of the lender to recover your unpaid debts, or they may sell your debt to collection agencies. Having your debt sent to collections negatively affects your credit score. If you cannot pay your debt payments or default on your debt and have debt being sent to collections, there are a few avenues to take depending on your specific situation. I will be examining debt consolidation, consumer proposal, and bankruptcy. You should always seek assistance from a local licensed insolvency trustee to determine the appropriate route for your unique situation. If you have been struggling to make payments here and there, one option is to consider debt consolidation. Debt consolidation allows you to move your various loans from different lenders into one consolidated loan. To be approved for this loan, you must prove you have enough income to cover the payment. The benefit of only having one loan is that it's easier to manage and budget payments. You now only have to make one payment on one date, rather than making various payments on various dates throughout the month. This allows you to budget and save each month for this date. Additionally, you will usually pay less interest on your total debt, resulting in a lower monthly payment. Another option to seek is consumer proposal. Consumer proposal is an alternative act to bankruptcy. In a consumer proposal, a licensed insolvency trustee works with you and your lenders as a mediator to come to a fair agreement to settle your debt. In order to qualify for a consumer proposal, you must have debts greater than $5,000 but less than $250,000 and cannot afford to make each monthly payment. In a consumer proposal, you usually get to keep your assets, and you are guaranteed protection from your lenders and other creditors. Additionally, consumer proposals allow you to have a fixed and lower monthly payments than combined debt payments. The main disadvantage of this is that your credit score remains temporarily affected for 6 years after you sign the agreement or 3 years after the agreement is completed. The final option is bankruptcy. You qualify to file for bankruptcy if you cannot pay your debts and the balance you owe is greater than $1,000. Bankruptcy provides you relief from your debt by agreeing to assign your assets to a licensed trustee. When you file for bankruptcy, it protects you against creditors and they cannot proceed to take legal action against you. The main disadvantage of bankruptcy is that it will negatively affect your credit score for a minimum of 6 years subsequent to the completion of your bankruptcy. Additionally, you are at risk of surrendering assets and any surplus income payments you receive during the time period of your bankruptcy.
Building credit. Building credit can be a difficult thing to do as a young adult, but it is crucial to develop and establish a strong credit score and a good credit history. Some factors that can help you get started are setting up automatic payments, as this will help avoid the possibility of late payments, as making your payments on time is critical to maintain a good credit. Start with a credit card with a lower limit. Being restricted to only charging smaller purchases to your credit card will help develop the habits of paying your monthly bills on time in full due to a smaller limit. You'll never want to max out your card, but having smaller charges will eliminate the burden of a bigger bill. Developing good financial behavior. Research and understand how the credit bureaus operate. The more credit card debt you accumulate, the more it will hurt your credit score. Start building your credit history. Apply for your first credit card. This will be your best beginner tool to building a credit history. Take your time and create a budget. Factor into your budget what purchases you plan to make and if you can afford the payments that will come with those purchases. Try not to be impulsive and spend within your income. Show a regular payment history. You'll want to minimize unsecured debt, but don't get more than one credit card because you'll want to stay on top of payments. And if you can't get your own credit card just yet, ask to be authorized on your parents' credit card. If they have a good credit history, you can get a credit card linked to their account to start building credit under your own name. What types of debt can affect your credit? The biggest factors that affect your credit counting towards your score is payment history and the amounts of debts owed. Some elements that are not as obvious as others are unpaid traffic fines or parking tickets. Third-party companies like Impark at CNC, if they go unpaid for too long or you continue to accumulate more tickets, they can get sent to collections and that can then impact your credit score. Having an overdraft protection and non-sufficient fund fees. This may not directly affect your score if dealt with in a timely manner, but your financial institution has their own credit checks with their clients. And if you don't want to be in a position where you're using your overdraft protection regularly. This can minimize chances of getting approved for certain credit options with them. Unpaid taxes. The CRA usually won't report to the credit bureaus, but if you owe a significant amount where you must attend court and a collection agency gets involved, it becomes unavoidable from the credit bureaus. Utility bills, internet bills, phone bills, rent, and car payments. These are your regular living expenses that if they are unpaid for too long or not only will you get cut off from using them, but collections will get involved if not dealt with. And repossession of your vehicle will happen if you stop making payments. And company charged accounts. These are accounts payable to the companies you have purchased goods or services from. Depending on the severity of how much you owe, these companies will either no longer do business with you or get a collection agency involved to get paid if you do not come up with an agreement to pay them back. What doesn't affect your credit? Your personal information limited to your name, current previous addresses, social insurance number, and date of birth. All this information will be on your credit reports, but what's not included or factored into your credit score is your gender, sex, marital status, race, level of education, the political party, or religion. Steps to rebuilding credit. Some steps to rebuilding your credit are reviewing and checking your credit report for areas of improvement or errors if it is your responsibility to make sure everything on your report is correct, so nothing can bring your credit score down. Bring your accounts up to date and pay down your debts. Contact the creditors in which you owe money to negotiate payment arrangements. Paying down your debts will help you utilize your credit, as you'll want to be in a position where you're using 50% or less of your available credit. Obtain a secured credit card to rebuild credit, as it directly affects your score. This is to establish and rebuild a consistent payment history. You will need to prove to creditors that you can pay back money borrowed and make at least the minimum payment by the due date. It is very important to have a reliable payment history, so at least make the minimum payment if need be. And create improved financial habits and behaviors. It is best to always have a budget so you'll know how to live within your means. Have checklists or reminders for when bills are due to help you remember where your money needs to go. And our question for our presentation is, what are the 5 factors that affect your credit score? And our conclusion. Thank you for watching our presentation on credit.